Cash-strapped, debt-ridden people are in abundance these days as we see the effects of quantitative easing making their way to Main Street. People don't have the money to pay their bills unless they tap into equity. We watched all forms of debt increasing, and the average person is unable to cope, only taking on more debt to pay the payments of the other debt. This merry-go-round will continue until it grinds to a halt. You came here for the truth, so let me unveil that for you. I've got more unpopular information to discuss with you today. I'll be the bad guy. I'll be the punching bag. No worries there. Homeowners are sitting on a record amount of cash and not tapping it. That's right. Homeowners have a collective $5.8 trillion in tappable equity, the highest volume ever recorded. We have seen prices of homes rising far beyond the levels that they hit in 2007. And all markets seem to be doing well right now for the most part. If we look at the top 50 cities, the prices have clearly come up. And this has shown us where the majority of the population lives, prices of homes have risen, and that does not compare to their wages. Okay, the prices of the homes have risen much, much faster. So this right here connects in with some other issues I want to discuss, but let me just finish off quickly. The average homeowner with a mortgage gained $14,000 in tappable equity over the past year, and that's $114,000 that they're available to draw. In this article here, it upset me quite a bit to see information that was written where this writer actually said they don't know how rich they are, and she was suggesting that people should be using that equity. You're not wealthy because you have equity in your home. It's, as far as I'm concerned, should be just sitting there for eternity if this is your own personal home. Yes, if you ran into some troubles and you really, really needed it, maybe you can use it, but it should not be used as an ATM. It should not be used as a bank account. That is highly, highly risky behavior, and people are doing it right now. It is going on more so than we've ever seen before. They're saying they're not tapping into it. However, just look at the prices and how fast they have grown. Over the last year, some of these markets have increased by over 10% in 1 year. So imagine if that's $1 million home. That's a lot of money. The average person really isn't going to be spending that, but they will be spending some of it. Remember that. They're going to be cashing out. So there are different ways they can cash out using a home equity line of credit. They can cash out, just take the money, or they can do whatever they want with it. Necessarily, it's not going to be able to be defined in any particular statistic. Well, we're going to talk about home equity line of credits. They have, according to this, variable interest rates, unlike the 30-year fixed primary mortgage rate. So the rate on the home equity line of credit can change, but I would suggest to a lot of people today are in fact using variable mortgage rates for their homes as well. So there's no way that you can tell me that this home equity line of credit is where the variable rates are, because people used home equity line of credits and mortgages with variable rates simply because the rate is lower. It tends to be lower, therefore they're going to use it. That's just a matter of fact. They're told that, hey, you can just basically change it up. Don't worry about it. If we see the conditions changing, we'll just go to a fixed rate. No thanks. I'd rather know exactly what I'm paying for the next few years. All right. They're talking about increasing interest rates by the Federal Reserve and how that increases the risk. When you look at it, it's very clear where central banks are going. It is expected tomorrow, at the time of this recording, tomorrow the Bank of Canada is going to increase again. We saw the Federal Reserve increasing recently, and they're doing so, increasing more and more and more. It is very, very slow. It's taking way too long to do it, but this right here brings us closer and closer to the end. We're at the edge of the cliff right now, and there's no way to ever sustain this. It is absolutely mathematically and certainly impossible for it to continue. Who wants uncertainty when it comes to monthly finances? I think a lot of Americans look at, what are my payments? What is my income coming in? And so on. They are completely BS articles that they are writing here, as if people care about that. Look, the new iPhone comes out, there's a whole bunch of people standing in line, and I'm sure a lot of those people can't really afford it, but they buy it. So can they afford it? What's the issue here? Of course not. They just take on debt. Nearly 80% of tappable equity is held by homeowners whose current mortgage interest rate is below 4.5%. 60% of it's held by borrowers whose rate is below 4%. And all of these here will be increasing in the near future, slowly but surely. The next time they go to refinance, I assure you these rates will be higher. Still, those who are tapping equity are doing it more through cash out refinances than home equity line of credit. Originations for these are flat, and the amount of equity being withdrawn that are originated is on a 2-year low. They are cashing out. They want money, paper money, and they want it to buy iPhones. They want it to buy food. They want it to buy everything else. They're not using it to basically do renovations in the home and things like this. That's not what it's being used for. It's being used on things they need on a daily basis. That's when people become too arrogant. They will be punished. The hottest housing market in the U.S. is up 13% and now may be headed for a crash. That's according to CNBC. You can see a difference of opinion here, one market to another, one writer to another. And here you're looking at Washington State, Seattle specifically, where prices have risen considerably over the last year. As prices have risen 13% in 1 year, what does that do to individuals' equity? You can see how it has increased. But of course, if these people start pulling out all that equity, what happens when prices fall? What happens when interest rates rise? What happens when both happen? Well, then you have a major catastrophe. Manhattan homebuyers demand bargains, walk away, anything but overpay. Wow. All right. What you can see from this article is that we are looking at 54%, if I can remember clearly, there we go. Of the sales that were completed in the quarter, 54% were for less than the asking price. Another 37% of transactions closed at the asking price, but often that figure had already been reduced. Most sales are going for less than what the people initially put it on the market for. That's what you need to know. Almost all of them, 54% and 37%. We are looking at nearly 100%. Something's changing big time in Manhattan, and it's very, very unusual because this is one of those places that would see a bull market long after the rest. But I believe that the prices are simply absurd. Now, taking the national average rent I just showed you recently, I got more recent numbers. $1,400 on the national rent. That's not really an accurate way to do it. I want to be able to drill down further. When you look at this, the 10 highest rents, the 10 lowest rents, look at Manhattan, over $4,000. This cannot be sustained. Prices are way too high. San Francisco is not too far behind. Boston and many other areas just below that. On the right-hand side, you can see the lowest rents, and the difference is significant. They're both houses, they're both condos, however they're measuring this, and look at the levels. I mean, we're talking about such a jump. It's not 2, 3, 4 times bigger. I mean, it's ridiculously high, just comparing the top of each. Looking at the next one, I want to show you the most significant year-over-year rent changes in June 2018. Look at Las Vegas, 7%, San Diego, 5.4%, and so on. Others haven't fared so well. You can see the slowest here showing us, for example, Baltimore. We know what's going on in many of these areas where they're seeing a lot more of unfortunate circumstances, whether it's economic issues, whether it is crime issues, and we're seeing the effects of that. Residents of California City, once known as America's foreclosure capital, are set to get a monthly $500 stipend with no strings attached in a bid to boost the local economy. This is the universal basic income. They're being given to 100 residents for 18 months. They're going to track the progress and see what happens. I want to know your thoughts about the universal basic income. If you want to know my opinion, which is not important, my opinion is that this should not exist and it will do nothing to support the economy. If we simply fix the problems at the root, you would never need to give money to anybody. Fix the root cause. Do not put a band-aid or a bandage over top. This right here, what would you pay for that spot of land? So we're looking in the middle of the city here. Looks like some sort of suburb. I won't tell you just for a second here, but it is let's call it a wealthy neighborhood. I will tell you that it is an expensive neighborhood. Okay, what do you think? I believe it is just slightly over 1 acre property, so it is a large area. What do you think you would pay for something like this? Take a guess. I'm going to show you. 1 acre. All right. Would you pay $15 million? That's right. Have no fear. In Palo Alto, California, prices are so reasonable right now. In this time frame, $15 million for a plot of land. Congratulations. Now this site here, if you've never seen it before, I highly, highly, highly recommend checking it out. The statistics are incredible. If you're a geek like me, you'll love this website. I don't know how to pronounce it. Numbeo. Looking at this, you can see the details of everything. I mean, I can type in a city like, we'll say San Francisco. I can type that in. I can get all of the statistics. Now, when you're buying a home, the most important one that I would say is this: price to income ratio. The average historically is 3 to 4 times, and here we have 9.65. So we know that the average salary, the average home price doesn't add up. I can see all different statistics here. I won't bore you with it, but I know that it is my duty to you to inform you, not just show you charts and articles, but try to empower you and inform you with as much information as I could possibly provide. This is numbeo.com. Highly recommend checking it out. That's all. If you found this video informative, please give me a thumbs up. If you hate me, hate my face, give me a thumbs down. Have an opinion, please. Last but not least, if you want the financial education you were not taught in schools intentionally to keep you away from knowing the truth, these 2 books have it all. You can check them out at Amazon. There are links in the description of this video. And if you prefer the audiobook version, you can get that at themoneygps.com.